Most investors assume reinvesting dividends is always the smartest move. But after running the numbers on dozens of income ETFs, I discovered something surprising. Some funds actually produced higher total returns when you didn't drip the distributions. So I created something I call the drip score, a way to measure whether reinvesting actually created more wealth or quietly destroyed it. So stay tuned. Welcome back to Simply Money. Today we're talking about something almost nobody in the income investing space measures correctly. Most people only look at yield, monthly income, or total return. But that misses a critical question. Did reinvesting the distributions actually outperform simply taking the cash? Because in high yield ETFs, DRIP creates a massive compounding advantage. But in others, reinvesting just buys more shares of a declining asset. I built a metric called the DRIP score. The DRIP score directly compares total return with DRIP versus total return taking the distributions as cash. And the results completely changed how I evaluate income ETFs. Today I'm going to break down how the DRIP score works, why some popular funds score surprisingly poorly, and which ETFs historically benefited the most from reinvesting. Because a huge yield doesn't automatically mean DRIP is helping you build wealth. Let's dive into the worksheet. If you're new to Simply Money, thank you for joining us. I appreciate you being on the channel. I hope you find this information valuable. Just remember, this is for informational and educational purposes only. This is not financial advice. Please make sure you do your own due diligence. For those who have watched the channel before, you've seen these drip sheets that I do. What we do here, and I'm just going to show you one as an example. You have the date the ETF was brought into inception, what the share price was at that time, whether it's a monthly, weekly, or quarterly payer. I put the ticker symbol here, and then we can put the amount that we're investing. And in this one, I usually use $525,000, but you can put $5,000, $10,000, whatever you want. And I'll even put this one down to 50,000 for this video here. And so that shows you how many shares you can buy with that amount if you invested that. In the columns here, what we have is the date of each distribution, what the share price was on that particular date, how much the dividend per share was, and then how much the dividend payment was based on the number of shares you have. And we usually do three scenarios. We have the full drip, and then we do a 50% drip for those who are taking some of the cash but reinvesting some. And then we do a zero drip where we take all of the cash and we're not buying more shares. And these columns show the number of shares you're accumulating in the full and 50% drips. And then over here in column I, J, and K, you have the full drip, the 50% drip, and the no drip portfolio balance, how much the balance is. And then we track what the yield is each time it pays. So you can see if the yield is increasing or decreasing. And so we do this a lot, and I have all these worksheets available at Buy Me a Coffee, which is in the description below. There's a link. Feel free to grab those individually, but I'm compiling this into one master drip sheet that we're going to have a summary of so you can see whether it's better to drip or not drip using the drip score that we have. As you can see on this sheet that I have, and I've been building this and I'll continue to add ETFs to this, we have all sorts of ETFs on here. And I'm going to go over to the summary sheet, and you can see over here on the left the ticker symbols. And these are all the drip sheets that are available on this currently. And I'll again be adding more to this. And what the summary sheet does is it pulls from each individual. So you can go in to Ulti, TSYY, any of these tabs. You can set the date and you can set the amount that you're investing, or you want to compare. Say you're doing 5,000 and three different funds. You can compare these, but you can control what sheets have what amount in them and what the start date is, which is important in this because different start dates will give you different drip amounts, different total return amounts, and the drip score and how that works. And we'll look at that a little bit more in depth. So stay tuned. Do not turn away yet. You're going to see how valuable this can be when you are buying these ETFs. If you do your own due diligence and you decide, hey, I'm going to buy an ETF It is valuable for you to know whether you should be dripping or not dripping. A lot of people think it is automatically better just to drip. I had someone just recently comment on a video. They said, "Oh, dripping made more money than not dripping. I could have done that video in 30 seconds." Well, first comment, and jokingly, I could say, wonderful. When you start your YouTube channel, do some shorts and you can do a 30-second video. But I didn't want to be sarcastic because that's a mistake a lot of people make, is assuming that dripping automatically pays more. It does not. There are funds, and we're going to look at a couple here in a minute, where taking the cash actually provides a higher total return. On the sheet, you can come down here and look at all the different tickers. So we'll start here with QQQI, and it pulls the price appreciation from the time that you put in that you started buying. If you looked at QQQI, you would see from the start date that you put in until today what the price appreciation is. So if you change the start date, this will update. And all of these obviously will update as well. What your total return is for full drip, 50% drip, and no drip. With QQQI, you can see that doing full drip, you did better than if you did no drip on total return. You can also see from the time you put in there, again, these are all date relevant. When you put the start date, you can see what your yield on cost is if you did the full drip, 50% drip, or no drip. And this is important too, because for something like SCHD, which you see right here, people say, oh, it only has a 3 or 3.5% yield, but you see your yield on cost on these different scenarios. Even taking the cash, your yield on cost is 12%. So if I invested $50,000 or $10,000 back in, I think this is set at 2011 when it was brought into inception, my yield on cost, I would be making 12% on that capital now, which people don't realize how that's growing and compounding. Not only is your portfolio growing, but they're paying higher and higher distributions, which makes your yield on cost go up. The yield on cost is really important to see as well. And you can see how you're compounding and growing, or in some, you're actually making less. Your yield on cost goes down. It may pay 15% yield today, but in 5 years, if you continued taking the cash, you might see that your yield on cost is only 10%. So that's something to keep in mind as you're looking at this, especially if you're going into retirement or looking to use this income. Then over here, we have what the average yield is. Each and every time it pays, what is the average yield it's been paying from the time frames that you're looking at? So again, all this will adjust. And if it's negative, you can see that it's in red just for visual ease. Now, the new part, the part that is really cool, and all this here on this chart you're looking at right here is just pulled from all the individual sheets. All this information has been on the individual sheets. As you've looked at the individual sheets, some of you own the individual sheets. You can see, like QQQI, you have all this information. But what you don't have, and what is new and what is helpful, if I want to evaluate these ETFs and then others that I'll be adding, right here, the drip score. If it is in green, it means you actually get a total return that is greater than if it is yellow or red. If it is red, it means that you're getting a higher total return if you take the cash. Yellow means it's probably about equal, give or take. In 1 week or 1 month to the other, it could change. It's very close. And so one downturns just slightly, and it's something you'd want to monitor. But the great thing is all of these sheets will update. Every time there's a distribution, it updates. It puts the new date in, the new share price, the new distribution, and it updates all of this automatically. This one right here, SPYI, you see is at 3.97%. Perhaps that drops some and goes to yellow. It may be something you want to look at. You can monitor whether it's more beneficial for you to drip or not to drip as you're trying to make these decisions. It's just a tool. This is not a cut and dry. This answers all your questions, but it does give you a nice visual, easy to recognize. Should I be dripping? Should I be taking cash? Do I need to really monitor this? And this is how this chart will work for you and help you. I want to go to a couple here that we see in red. Let's go to a really obvious one. PLTU, can see that the price appreciation is gone up. So people think, well, the NAV has gone up, the price has appreciated. it has to be beneficial to not take the cash. It has to be beneficial to drip. We can see that the total return with drip is 95%, but total return with no drip is 118%. It gives us a high, very high, negative 22% score, which means it is better to take the cash. Red means better to take the cash. We're going to look at the PLTU drip sheet. We just come over here, this little 3 lines here. Scroll down till you see PLTU, not PLTY, PLTU. There it is. Click on that, takes us to it. Now, this is one of the reasons is this is very new. Now, this is only a little over a year old, so you can see there's not a lot of distributions. And right here is what throws it off. There is a special payment that was made out. Look at that, $15 put out on this per share in December of 2025. That really throws everything out of whack, and that's why it is so high in making it deceptive, and why you would have been way better off taking the cash, because in the scenario of $525,000 invested, it would have paid $291,000 in one payment. It throws things off. You can see that as an 84% yield, which is ridiculous, and where it's normally paying 1, 2, maybe 3%. We come down here, you see the average yield is 13.82%, and it is all out of whack because of that special payment. So you see your drip score down here. And that's why on the summary, we have this red flag. Like if I was owning this, it would be more beneficial. Now that is one that has an outlier, just a strange distribution that was paid. Let's go to one that's a little closer that a lot of you are familiar with. Let's go to MSTY, MSTY. Now we all see this. This is what gets us, and we think, oh, this is not good. And this, in my opinion, is not good. Negative price appreciation, negative total return in all 3 scenarios. But, and this is a big but, your negative total return is less of a loss if you're taking the cash. Nobody wants to hear that, like, oh, well, I'm going to take the cash so I have a less of a loss, but it's still a fact. Your total return is 9% greater if you take the cash. Now, MSTY has been a deadbeat. We don't like that. We have to look at these and just realize how they're operating. Just because something is negative, though, look at LFGY right here. It has an even bigger price appreciation drop, negative 56%, but it's over in the green. It is green with 6.2%. It hasn't done fantastic, but if you were dripping, you're up almost 6% from if you were taking the cash. And at least you're in the positive. There's a lot of things you can look at here. We'll look at one more. OARK, look at that, 65% share appreciation drop. That is huge. That's a red flag, and everybody's going to go, I am not buying that. No way would I want to own something that has that kind of NAV erosion. But look, total return, 59%, doing 50-50 drip, 40%, doing no drip, 28%. So just because you have a negative price appreciation doesn't mean you want to take the cash. If you reinvested, look at that, you'd have almost 60% return with total drip. And that's where you got the green light, and it's a very high green, 31%. Keep that in mind as you're looking at these different funds. And this is what people do a lot of times. There's not a one answer like, oh, I'm going to look at the NAV. If the NAV's negative, I'm not buying it. Or if I do buy it, I'm taking the cash. And that's not always the best move. There's a lot of variables, and this gives you a nice cheat sheet. Along with that, over here, we have this image to help you. What is the drip score? It's a real-world comparison of 2 strategies to measure which one actually created more total return. Here's the drip formula that I use. If you're wondering how I came up with that, how this drip score over here is calculated, that's it right here. And if you want to plug this in for your own, maybe it's not listed here, you can take this and do that. And this just kind of walks you through how to read the drip score. Positive score, greater than 0. Green, drip is better. Yellow, it's near 0. Very similar outcome. Red, negative, take cash is better. So that's how you read it. And right here, look at this. This is something to look at. If you have for example, 20% positive, drip created 20% more total return. If you have 5% positive, drip created 5% more total return. 0, they're both equal. And then obviously the reverse is -5%, means taking cash created 5% more total return. As you're looking at this chart, I can look here and say, oh, taking cash gave me 22% more return. Here I can look and say dripping gave me a 31% higher total return. Just an easy way to look at that. And there's also something here, and we're not going to get into this too much. This is an income versus decay ratio. This is a little bit different because this isn't just looking at which one did better. If you use this formula, and I can add this on here, we can put another column over here, and we'll have the same thing with the red, borderline, and weak, meaning that the income, if it's green, the income comfortably outpaces the NAV decay. And that would help you know, is this going to be losing money? It's not just which one's going to lose less in if I drip or don't drip, like with MSTY. Okay, so I'm back. I decided to go ahead and edit this and throw in a little bit extra for you because what I've done here is I have added the income versus decay ratio. We've discussed what the drip score is, and we're going to look now at what the income versus decay ratio is. But the drip score only tells what happened historically. It doesn't tell us whether the fund itself is structurally healthy for long-term drip investing. That's where the income versus decay ratio comes in. The income versus decay ratio compares how much income the fund pays versus how quickly the fund's NAV or share price is decaying. Think of it like a leaking bucket. The yield is the water going in. The NAV decay is the water leaking out. This ratio tells us whether the income is keeping up with the structural decay of the fund. Let's walk through the scoring of this. You can see this row here in column K. You can see these different colors and these different scores. The 99 in purple, that means excellent. This means the fund actually has positive NAV growth instead of decay. Purple means you're getting income and the share price is still healthy or growing. That's the strongest long-term drip environment. Now our green, we have above 2. That would be strong. The income is significantly outweighing the NAV decay. These are generally strong drip environments where the yield is comfortably overcoming the structural erosion. So you're looking at the green, that is strong, meaning the NAV decay is there, but the yield is much higher. And so you're actually gaining total return. So you want to look for the purple and the green. Now, our borderline, our yellow, that's 1 to 1.99. That's borderline. The yield is roughly balancing the decay. Drip may still work well, but the margin of safety is very small. Those are the ones you want to keep an eye on. A lower distribution one period could bring that into the red. A higher distribution could bring that back up into the green. So you have to keep an eye on it much more when it's in the yellow. And below 1, like this right here, the 0.49, that is weak, and those are in red. The NAV decay is overpowering the income. Even though the yield may look attractive, the underlying asset deterioration may be too severe for long-term drip compounding. The really powerful part of combining these two metrics together, because now we can see that whether drip historically worked and whether the fund structurally supports long-term reinvestment. Some ETFs may show strong historical drip performance while still having weak structured decay profiles going forward. And honestly, this completely changed how I evaluate these high yield ETFs, because yield alone doesn't tell the full story anymore. So please look at this, do your research, and make sure you're understanding that you're not getting sucked in by a yield when it is actually losing value, or that you're dripping when you should be taking cash, or if you're trying to get the best total return, that you can understand which method would get you that best return. And this will help keep this live because it's updating. Every time a distribution is paid, this sheet will automatically update for you. And so these may change colors over time. If you do order this, be patient when you go to load it. As you can see, there's a lot of data here. There are tons of tabs being hidden that is pulling all this data in. It's live feeding it, it's updating it, it's refreshing. So sometimes it may take a moment depending on your upload speeds, depending on your computer. It may take a minute to initially load. You'll see pound references in some of the cells. Give it a moment. Let it do its thing. It will populate. It is working. It is wonderful. Make sure you leave a like and a subscribe down below so others will get a chance to see this video as well. I appreciate all your support, and we'll see you next time on Simply Money.